Well-paid execs are out of control with their stock buyback spending again. This is your morning jolt, and Goldman Sachs hit our inbox very early with an interesting data dump. I mean, that is, look, for the first time in 10 years, stock buybacks are accounting for the largest share of cash spending by S&P 500 companies, says Goldman. The numbers are, they're almost staggering. Half these CEOs learned nothing from the lead up into the Great Recession. Look at this. Buybacks surged by 48% to $384 billion during the first half of the year. Now, on a somewhat positive note, execs are throwing the economy a bone on terms of CapEx, which ultimately helps grow the economy. So CapEx spending is up 19% to $341 billion, says Goldman, in the first half of the year. Stock buybacks, what's going to happen in the second half of the year when execs pull back on these end of year bonus boosting buybacks? The market's going to lose a key profit, and that's very worrying heading into 2019 ahead of more interest rate increases. Sorry to be bearish, this is just what the reality is right now. Okay, next up, a little bit of a morning op-ed. Staying a little bearish because why not? Everybody's so bullish. You see all these talking head pundits out there. The market continues to ignore President Trump and his full-blown trade war. We got news on Friday, which is turning into the Friday news dump per the usual from this administration, that they're going to slap almost 200. They're going to slap tariffs on 200 billion of Chinese goods. Now the market seems to be liking the fact that it's only going to be a 10% tariff reportedly, compared to a 25% as was reportedly rumored. It's still not good, people. Higher prices are already starting to trickle throughout the economy. Every executive that I've talked to the past 2 months have said they're raising prices, in some cases in more than 10%, to offset higher cost of aluminum, steel, and other commodities that have resulted from the early onset of the trade war. So this is a problem. It's unsure how consumers will respond, but at the end of the day, when you go into a Walmart and suddenly your shopping trips are costing $30 bucks more than they previously did, at the end of the month, you're $200 lighter in some cases. That spending has to come out somewhere. Maybe it's a few less movies purchased from Netflix, but this is how investors need to start thinking about this stuff, because it's going to come home to roost. It may not come to roost in the third quarter, maybe not the fourth quarter, but it will, and probably in the first quarter of 2019. I know it's too far away from you. You only care about day trading stocks right now. I'm just trying to prepare you for a potential reality. Next up, around the street, a little short. Today is TheStreet's holding a cool closed-end fund webinar at around 11-ish. Tune in or register. Go to TheStreet.com to register for that webinar. If you have no clue what closed-end funds are, they're just a way to make you money. So we'll tell you what closed-end funds are. They're one of the oldest investment products around. This webinar will help you make some money there. And then lastly, Jim Cramer is still bullish on Salesforce stock, and I mentioned that because Marc Benioff, in 30 days or so, and his wife, Lynne, will be owners of Time magazine. It'll be very, very interesting to see where Fortune magazine goes next. Benioff spent $190 million on Time magazine. He reportedly has no interest in buying any other of the Meredith publications, Money, Fortune, etc. Why doesn't Warren Buffett should buy Fortune? He's pretty much written up there every single day for the past, 15 years. That's all I got for you. Sign up for that Morning Jolt newsletter down below. Have a great Monday.